know most of you expect a bombastic intro to these videos where we talk a little smack about the bears, but today I want to cut to the main point. We are back.
We are back, baby. We are fucking back. We're back. We are back. We are back.
Let's roll the tape. Welcome everybody to the daily recap show where we talk about stocks and the financial markets. My name is Chase. If you like this video, please subscribe, hit that notification bell as well as the like button and leave a comment for the algorithm. Let's get into it. This is the daily heat map of the S&P 500 and a very mixed day. We had clear winners, clear losers. The standout today, Tesla up 22%, adding over $80 billion in market cap on yesterday's earnings. Elon coming out and saying sales could grow 15 to 20% next year. Margins also expanded across the entire business line. And like I always say on this channel, when earnings are growing and margins are expanding, stocks do very, very well. And the proof is in the pudding. Tesla up 22%, the best performing stock in the S&P 500. And Tesla's sentiment helped the overall discretionary space. Amazon was up 0.84%, Home Depot, McDonald's, Bookings Holding. This entire sector did very, very well apart from a couple of names. We also saw very bullish price action in technology, particularly software, very upbeat on the back of Tesla's news somewhat, as well as semiconductors. Relatively speaking, they did very, very well, except for Broadcom AVGO. Looking at the other mega caps, Tesla's outperformance failed to extend to stuff like Microsoft, Apple, Google, and Meta. However, still a flat to slightly up day on certain names. Meta up 0.53%, but Microsoft virtually flat on the day. Other than that, there was a very mixed day across the board. The best performing sector today was clearly the discretionary space, up 3.22%, a huge outsized move, massive alpha relative to the S&P 500 and even the second best performing index, which was the XLC, up 0.36%, the XLK up 0.34%, and real estate up 0.33%. So rate sensitive sectors and the mega caps really leading the charge, I guess, today. However, still a relatively small move compared to XLY. XLF and XLE for financials and energy did gain, even if it was ever so slightly today. And then the losers today, staples, healthcare, industrials, utilities, and materials. So anything that was defensive didn't really do well today. Large growth was the best performing factor and size segment, up 1.3% today. If you were positioned in growth, you did really, really well. Other than that, it was a fairly average day in the market, mixed across the board. Mid cap core was down today. Large cap value was also down today. But we saw fairly good returns in small caps. If you were in mid cap growth, you did very well. Mid cap value as well. A very mixed day in the market, but you can't deny the bullish trend we did see, particularly in large growth. And this also stemmed off some economic data we got. The economic data we got today was actually very positive. Initial jobless claims came in at 227. The forecast was 225. That's a positive. We also saw PMIs came in better than expected. Manufacturing or goods came in at 47.8. The forecast was 47.5, so a slight beat. The market's always going to view that as a positive. Services came in right in line with market's expectations. Growth at 55.3, and then new home sales 738,000 versus 720,000, and that's why we actually saw upbeat action in XLRE, the real estate. Overall, the economic data continues to come in line and or slightly stronger than expected with these initial claims and new home sales. And this did support the overall price action we saw in markets as well as earnings. Earnings this season have been very, very good. I mean, today Union Pacific missed earnings by 0.93%, and that was really it. We saw S&P Global surprise earnings to the upside. Same with Honeywell. KKR, a huge beat. UPS up 8%. Northrop Grumman, huge beat as well. Carrier Global Corporation. So far, earnings season has been very strong. We've seen strong beats on both the earnings side and the revenue side. And fundamentally, stocks have never ever looked better. Looking at market breadth, we saw a mild improvement over yesterday compared to today, especially in the 20-day and 5-day moving averages. However, medium term and longer longer term averages continue to stay where they are, and they look very, very solid, and trends are intact very long term. We're just seeing a little bit of volatility here in the short term, and that tends to happen in the month of October in election years. Do expect that volatility to continue into the early part of November and into the election. I think after the election, once we get that confirmation, once we get that assurance of who's going to be the president, then we can continue the move to the upside with conviction. But for now, any volatility we do get, you want to buy the dip, and you want to buy that dip very, very quickly. Now, what supported price action today, along with stronger than expected economic data, as well as the earnings picture, is just the movement we saw in yields. The 2-year, 10-year, and 30-year yield actually fell today. I don't think anybody was surprised by that. The price action in yields in the last couple of weeks has lent itself to a bit of a pullback, and that's going to support the overall markets. We also saw a pullback in the dollar. Again, yields and the dollar are sort of moving in the same direction right now, and expect that trend to continue. So if yields are up, the dollar should gain. If yields are down, the dollar should fall, and that's going to obviously weigh or support equities in whichever direction it goes. Gold was up 0.77%, but silver did not participate in the rally today, and equities, the real outperformer, particularly the Nasdaq 100, we all know why. Tesla, the S&P 500 up 0.21%, the IWM was up 0.22% today, the RSP was kind of flat, mid-caps up 0.17%, and we also seen some very positive developments here in the after hours, especially in stuff like the IWM. Guys, small caps, if we look at the RTY, really holding in there. I mean, if we look at the 10-year yield, right, we go to the year-to-date chart of the 10-year yield, right here, that is when the Fed cut rates, where we went from the 3.6% range to the 4.2% range. That's 50 to 70 basis points worth of a gain to the upside, right? You think small caps would get absolutely hammered. In that time period, small caps have actually rallied as well. And that's because a lot of the move in yields is on the back of just stronger economic data. And that's a really good thing. And I think small caps are acting very, very strong. We're sort of just building out a base right here, looking for the next move to the upside. And I do think that's going to come towards the end of the year into the start of 2025. The IWM's gamma flip and put support zone did not move at all, meaning, guys, that if you do get an opportunity here at the 2190 area, you want to buy that. We didn't see it move down. We didn't see the gamma flip move down. I really did think we were going to see a move down just to offer more support at these lower levels, but it seems like this level right here, which is also the low we put in a couple of weeks ago, is probably going to hold. And I do think that this 2190 area is a great place to get long in small caps. I mean, below here, it does open the 2000 level, so you do want to play your risk accordingly, maybe scale in, but this looking very, very strong. Small caps, there's a lot of underlying strength in small caps, but especially if you look at something like small cap quality, it was up 0.51% today. A lot of underlying strength in small caps that not a lot of people are paying attention to, because the mega caps have really taken all the attention, particularly Tesla. Strong move for Tesla shareholders. Look at that candle. That's literally a gap up and go, hitting the highs we saw here, 260 and above. And I think we're probably going to see like a $300 Tesla before the end of the year, before the next quarter. This is really going to be supportive for Tesla stock to climb over the next couple of weeks, over the next couple of months, I should say. The Nasdaq 100 was up 0.83%, still above the gamma flip zone. And that's what we spoke about yesterday. We said we did enter negative gamma. However, in the after hours, we did see a gap up above, and that's why I was wary of saying don't take shorts just yet because of the fundamental news we got in Tesla yesterday. And as a result, we're back in positive gamma after a very solid day. And I do think that Tesla's earnings bodes very well for what we should see in the broader mega cap space, which is just huge outperformance in earnings. But we'll see how that translates into moves in the stock market. Nonetheless, I'm very bullish on these previous all-time highs being taken out in the Nasdaq 100 very soon. We are in positive gamma, and the aim right now is the 20,600 or 675 level. The S&P 500 continues to trade inside this range right here. Very solid price action. We're in positive gamma, and right now nothing has really changed apart from the put support, which just moved up to the 57.25 area. So you can expect that this area right here could be a supportive base for the S&P 500 if we are to like slip back and move right there. That tends to happen. Call called volatility compression. A lot of the times when we get big moves in stuff like Tesla, we do see this type of volatility compression in the index level where we do get sort of flat trading, and then when the volatility expands, we tend to get a big move to the upside or the downside. And in the case of the put support, because most options are sold to collect premium, that normally results in an outsized move to the upside. Very, very similar to what we saw right here. We actually saw volatility compression happen at this point. The put support moved up, and then you normally get this trend to the upside. And do expect the same in the S&P 500. It just depends how long this consolidation period goes on for, because right here we had it for like a very solid 12 to 10 trading days, which is close to 2.5-3 weeks in trading time. All in all, guys, the markets continue to look very, very solid, and any dips we do get, like we did yesterday, you want to take advantage of them because the bulls are very quick to buy this dip. And generally speaking, this market that we are in right now, with a solid fundamental backdrop, a solid macro backdrop, a strong consumer with rate cuts on the horizon, that's a very solid backdrop for equities. And if you look at stuff like the 10-year yield, eventually this is going to pull back. Same thing with the dollar. We are going to see a pullback in the dollar. We've seen a huge move, and that's really going to support equities, because when the dollar falls, when yields fall, equities are going to do really, really well. That's going to support the overall price action that we are seeing in equities, along with strong earnings, strong macro, strong consumer. So when all of this comes together towards the end of the year, I think we're going to see equities, as particularly the S&P 500, run up above the 6,000. And I think a target of 6,000 to 6,100 is not a bad place to look for the S&P 500. And into 2025, I think 6,600 is also not a bad place to look. However, let's not look that far in the future, in the here and now. And right now, we just need to get through this election consolidation and October volatility. Once we get through that, off to the races. Guys, let's look at sentiment. This is the AAII sentiment survey. What direction do AAII members feel the stock market will be in the next 6 months? And we've seen a significant pullback in sentiment. What feels like the last 5 to 6 months, we've seen this AAII sentiment survey always above the 45% range right here, at some points into the 50, 51, 52% range. This is bullish sentiment votes, and we've seen neutral sentiment votes hover in the low 20s. We are starting to see a change. We've seen bullish sentiment pull back from the highs here at 49% all the way to 37.7%. We've seen bearish sentiment tick up as well from 25 to 29%, and the lows here at 20.6%. Absolutely crazy. A complete lack of bears, and this is very constructive. This is actually what you need in a market. You need buyers, you need sellers. However, you want to remain constructively bullish. Why? Even though sentiment has ticked down, I view this more as a moderation, because 37.7% in bullish sentiment votes is the historical average, and actually bearish sentiment votes actually slightly below its historical average, telling us we are still in a bull market. There are still plenty of bulls in this market, not that much bears, and you do want to remain constructive, because generally speaking, in this type of environment, stocks go higher, especially when earnings in the market moving sectors are looking very constructive. Technology and comm services, the two biggest sectors, which encompass infrastructure, semiconductors, and software, are reporting double-digit mid-teens growth, 14.9% in the tech sector, comm services 13.3%. You want to remain long because the market moving sectors are really reporting robust growth. Financials and healthcare also reporting 6.8 and 6.4% earnings growth, very, very strong. And largely the small sectors, industrials, materials, and energy, on a market cap basis, reporting negative earnings. So we have the big names doing the right thing, and that's why we're seeing the market at all-time highs. Now, earnings is obviously going to provide a tailwind to the market, but so too is yields. Now, I do know that yields have been a bit of a dumpster fire in the last couple of weeks. Since the Fed cut rates right here, we've seen the 10-year yield rally about 50 to 60 basis points above the 4% mark, and that is actually atypical to what we normally see. When the Fed cuts rates, the 10-year yield actually goes on a very slow trend downwards. We've actually bucked this trend. It's been a highly irregular move, but I do think that this is actually going to be a tailwind for equities in this third quarter. I think we're going to see yields pull back, and that's going to provide a tailwind for equities, and this is exactly what both are expecting. They see yields into the end of the year, the end of 2024, finishing at 3.85%. We're currently at 4.1. This chart's a bit dated. As of today's close, we're sitting at about the 4.2% level. So both see a pullback to the 3.85% range. That's a significant pullback. You're looking at about 25 to 30 basis points worth of a drop in yields. That's going to be supportive for equities because the dollar's also going to pull back. And what's also going to support equities is the highly favorable seasonals, especially in a year where the first half has rallied greater than 10%. This light blue line right here is years when the S&P 500 has had a strong first half rally. This is every other year. A strong rally is 10% or greater. While we are still in this volatile period right here, this end of October to November period, we can actually see a little bit of downside volatility. We do want to buy the dip because there are favorable seasonals. And if yields are to pull back, if the dollar is to pull back, that's further going to support the upside move we see. Not just when we've had a strong year, but also when we've had an average year. You can see that we normally do rally in every single instance. And the end of year, this final quarter tends to be very, very positive. And the truth is, guys, 56% of years in the S&P 500 peak in either January or December. What's also going to add to the tailwinds into the end of the year and why we want to buy any dip we do get, why volatility is a gift before this end of year run, is corporate client buybacks. They are the highest they've ever been, and they are expected to go higher into 2025. And this just goes to the confidence that management teams have in their business. And I believe on the 12th of November, that's when 80% of companies are out of the blackout period. And then we also have buybacks as a tailwind into the end of the year. Diving into the macro, looking at the Fed's GDP now sitting at 3.2%, looking at the US economic surprise index, the rising surprise index generally reflects positive economic conditions, which tend to boost investor confidence and drive equity market growth. We're officially above the zero line, very, very positive. After most of the year, we've been below the zero line when we saw negative data. We are now starting to see positive data. And that's part of the reason why yields are rising. They rise on the back of a stronger economy. And that's why equities, for the most part, have been extremely resilient despite a 50 basis point rally in yields overall. And with this positive economic data, TS Lombard had some very awesome commentary. They also go on to show how you should be allocated, or what their model deems you should be allocated into the end of the year. And they say improved US data has helped assuage fears of a recession. The Fed is cutting rates in what is still a strong economy. Preemptive cuts have historically been positive for risk assets. A policy shift in China signals greater determination to revive the economy and markets, although more will be needed. A recovery in the US and China, along with ongoing ECB easing, should support European assets, but uncertainty around the US election is a risk for markets owing to the gap in the policies of the two US presidential candidates. Possible post-election legal mayhem is yet another layer of risk. A contested election is what they say, and they believe globally you should be overweight developed markets, overweight emerging markets, underweight government bonds, especially in developed markets, investment grade credit and high yield credit. They advise to be overweight. They say underweight local CCY, which is like municipal bonds, overweight alternatives, and then market weight for cash. And then looking at their developed markets asset allocation, they say uncertainty around the US warrants a degree of caution. Despite the still positive macro backdrop, we keep a pro-risk stance in our portfolio, but have moved somewhat closer to our benchmarks, rotating from corporate to government bonds and from EM debt to EM equities. Our model portfolio's beta nudges down to 1.14 from 1.15. Their macro outlook. Although the latest put combo from the US and China has revived hope for a pickup in global demand, leading indicators paint a world economy that lacks impetus. The possible continued rise of oil prices, treasury yields, and the dollar could upend the going recovery in investor sentiment, and that's just it. If the macro data turns, yields continue to rise, and the dollar and oil rise too, that could dampen sentiment. However, you want to be overweight US equities, European equities, Japanese equities, UK equities, and Canadian equities. You want to be underweight Australian equities and Swiss equities. So really want to be in US, Europe, and Japan, and try to stay away from like the Australasia region. That's where TS Lombard believe you should be allocated to. Looking at data, guys, tomorrow we have the big data prints. We have durable goods and then University of Michigan sentiment. Now, durable goods orders, we have a huge range right here. Both for estimate an increase of 0.05%. The consensus is a negative 1%. drop in durable goods, X-Transport 0.3 versus negative 0.1, and then capital goods shipments 0.2, and then capital goods orders they see flat, University of Michigan sentiment to come in at 69. And looking at earnings tomorrow before the open, we have NYCB, Colgate Palmolive. That's really it in terms of big names. But if you've made it up until here, thank you so much for watching. If you like this video, please subscribe, hit that notification bell, as well as the like button, and leave a comment for the algorithm. Cheers.